Hello, good morning. Thanks so much for coming. Thanks to everyone for joining online, and thanks to all of you who are here in person with us. My name is Ben Cahill. I'm a senior fellow in the Energy Security and Climate Change program here at CSIS, and I'm really excited to have this event with our special guest to talk about energy markets. Before we start today, I just want to share with you our building safety precautions. We feel very secure in the building, but we have a duty to prepare for any eventualities. So I'll serve as your responsible safety officer. If anything goes wrong, please follow my instructions and familiarize yourself with the exit signs here and here. So now let's turn to our program. We're really pleased to have two well-known analysts. We have Amrita Sen, who's founder and director of research at Energy Aspects. She's one of the world's best-known oil analysts. She's consulted by governments and companies around the world, traders, upstream companies, the financial sector, you name it. And we have Joe DeCarolis. He's administrator of the Energy Information Administration, or EIA. Before coming to the EIA, Joe was a professor of engineering at NC State. He's an energy systems modeler, and of course he now heads an agency whose models and data are really essential to the global energy system. So I'll just make a couple very brief comments to kind of kick things off and recap what happened last year and some issues to watch this year, which I think both of our guests will talk about. So last year we had incredibly strong oil demand growth, really led by China. It was roughly 2.4 million barrels a day of demand growth, well above historical norms. And yet the market was relatively well supplied, and we didn't really see deep inventory draws. And this is mostly due to a huge surge of non-OPEC supply growth, led by the United States, but with additional supplies from countries like Guyana and Brazil and Canada as well. So despite the fact that we had a series of OPEC plus production cuts starting in late 2022 and throughout last year, non-OPEC supply was really robust, and we had a relatively balanced market. For the last couple months, prices have been pretty stable. We've been kind of in this band of $80 to $85 Brent for front month prices. But this year things look a bit different. There's this perennial expectation that finally shale growth in the United States might slow. And this might be the year that it happens. I think most analysts and forecasters anticipate that we are going to see a slowing of shale growth. And of course, in the last couple of weeks, we had an extension of the OPEC plus production cuts through the first half of this year. So I think a couple critical questions to address, and I know that our speakers will talk about this today. What happens with U.S. shale growth this year? Do we see that slowdown? Of course, what happens with Chinese demand? And with inventories and product markets, are we looking at a slightly tightening market as we get towards the middle of the year? So in terms of the run of show today, our first speaker will be Amrita Sen from Energy Aspects. She's going to give some opening comments. After her, Joe DeCarolis from the EIA will speak, and then we'll have a panel discussion led by my colleague, Joseph Majkut. So with that, I'm going to turn the floor over to Amrita. Amrita, thank you for being with us.
Thank you, and thank you to CSIS for having me, Andrew. It's really, really exciting. I'm going to keep the remarks short because I know we want to have a lot of time for Q&A. But yeah, I think you've touched upon a couple of things already, which I want to highlight, and first and foremost, very much around where we've started the year. We've actually started the year, or we came into the year thinking the market's going to be quite well supplied, be it thanks to U.S. shale growth. That's kind of surprised to the upside significantly at the end of last year. OPEC, yes, OPEC policy was going to continue, but demand growth wasn't meant to be particularly, especially after last year's 2.3 million barrels per day of growth, it was going to slow down. What we've instead seen is a market that is incredibly tight, and I know it doesn't necessarily show in the oil prices that we see. Yes, we've had a pretty big jump yesterday and today, but what's actually been very, very interesting for us to watch is the physical market. The physical market tightness, this is like the strongest the physical crude market has been, except for when Russia invaded Ukraine in 2022. And this disconnect that we are seeing between the physical market and the price of oil that like you and I see, it is quite concerning. I think it does raise the question about whether the price, whether the benchmarks are actually reflecting what's going on. I think it also tells you that traders who are ultimately kind of buying and selling futures contracts don't necessarily have the confidence, having been at the mercy of either SPR releases or OPEC policy, that they don't want to necessarily go long. But that doesn't take away from the fact that the oil market is actually, or has at least started the year, much tighter than we expected, much tighter than anybody really expected, because we've had draws in January. The bills in Feb, at least high frequency data, is tiny compared to our expectations, about 300,000 barrels per day versus expectations about 1.3. And it does look like, given the kind of expiries we are seeing in the physical market, that the market is actually drawing counter seasonally, regardless of what paper balances say. And one thing I'll say, and I'm sure this is going to be a discussion point, we pore over numbers, right? We do, the EIA does, the IEA does. But at the end of the day, the physical market is where the truth is, right? That's where ultimately the demand and supply kind of comes at, like this. That's where buying and selling is happening. And I think that's one thing we have to be very, very mindful of, is that there's been a lot of volatility in all our balances, a lot of volatility in the data, because the data revisions have just gotten bigger and bigger. So I think we always tend to at least go back to the physical market and be like, okay, are we missing something? Because like I said, we came into the year with bills expected in Q1 and Q2, whereas now that's kind of changed. Of course, OPEC policy is partly to do with that. And we have extended the OPEC plus cuts through Q2. We've highlighted that they were going to do that. We also think it's very likely that they'll probably extend a little bit beyond Q2 as well. Having said that, even if they don't, any incremental barrels coming back will be very, very gradual. So yeah, I think the market will remain tight, not just kind of into Q3, but through Q3. And then, of course, Q4 becomes a question mark, as always, with seasonality. The things I want to actually highlight very briefly, but quickly, are the following. Russia. Now, Russia is something everybody in the market has just kind of given up on in terms of predicting supplies. All of us have pretty much stable Russian production over the course of this year, because for the last 2 years, predicting Russian supplies would fall has been incorrect. But what we are seeing this year, and I think this is one of the reasons why we are actually seeing a tighter market than we had expected, Russian production hasn't fallen yet, but Russian barrels are not necessarily finding a home. Why is that the case? The sanctions that are taking place right now, different. Why are they different? Because you're actually seeing the US sanctions IMO vessel by vessel, as opposed to names of companies where the entities used to get changed. So we've lost about 15% of the vessel fleet that used to carry Russian oil to India, to China. This mostly the Greeks. And because they've disappeared from the market, the price of Russian oil being delivered has gone up quite a lot. And you have seen India, for instance, cut back a fair bit. The second aspect is actually around payment. This was not directed towards oil, but President Biden signed, I guess you could call it a decree or a law, which effectively was geared towards reducing the amount of semiconductor and chips imports into China. It sanctioned entities that were doing business. The problem is a lot of those same entities and banks also are used for oil payment. So Brazil, UAE, China, they've all come out and they have struggled, and they are currently struggling to pay. Ultimately, we do think that gets resolved, but these are more specific sanctions and probably more problematic sanctions than anything we've seen in the past. Price caps, we all know, hasn't quite worked. And finally, the thing is around Ukraine. Ukraine is attacking Russian infrastructure. And the narrative in this market, where everybody keeps saying to me, oh, the war is going to be over because there's going to be a different precedent coming elections in the US. Again, that's not even, I mean, regardless of what your views are on that, it's way too soon to say the war is over. But B, if we really do think that's the case and Ukraine thinks it's not going to get funding, do we think Ukraine's going to just sit there and not attack more and more Russian infrastructure? We've already seen a massive amount. Just the last 48 hours, the Russian elections are tomorrow through to 17th, elections as I call them. But Ukraine will absolutely ratchet up attacks. And that's going to probably continue, especially the longer these aid packages take. So I think that's very, very important to keep in mind in terms of the risks around this. It's not our base case. Our base case is still, we don't have Russian production falling very much. But the risk in this market is that nobody's expecting a big production loss. And by the way, that's why I say supplies. I'm not talking about oil as in crude or products. Product supplies, pretty confident you will see product supplies fall. You are already seeing it come off given these attacks. In theory, that means more crude to the market, but if that crude can't be delivered to the market because of payment issues and shipping issues, the market is going to tighten up. Second thing is around Red Sea. We do think the attacks are going to persist for months, but also I think for us, this is not about lost supplies, unlike Russia. This is much more about longer supply chains. Generally speaking, across Russia, across the Red Sea, what we've seen is far more inefficiencies now coming into the market. And where does this get reflected? This gets reflected in products prices, refined products, refinery margins, because refineries are having to tie up capital for longer. And this is a trend we think, just generally, the trend of kind of higher refinery margins are reflecting inefficiencies in the market will remain. I think that's definitely going to be the case. And the final thing I'd say we are watching is going to be US tight oil. And the amount of surprise, we all were surprised last year because we were thinking about 600,000 barrels per day of crude growth, turned out to be 1 million. Big part of that driven by M&A activity just before kind of getting taken over. All these companies surged production. Now the companies have come out and talked about they have to build DUCs. If you go through all the companies that report, it's only 2% increase in production this year. And then if you add on the privates, you get so our number is about 400,000 barrels per day. We're actually higher than the EIA on the crude side. NGLs is about similar, 350. But yeah, I think it's interesting how the narrative is slowly, it's just about starting to change. We came into the year, still people were very, very kind of bruised by the whole US production surge story. And look, I think this is very important for one simple reason, right? If we are all right and production growth is, say, 400 or even lower, that's fine. But suddenly, if we get a repeat of last year and another 1 million barrels per day, it does raise questions about OPEC policy, not for the June meeting, but for the December meeting. Then it gets harder and harder for them to continue with their policy. And then there are questions about, of course, then prices would be significantly lower next year. On demand, we do think green shoots are emerging, particularly out of Asia. AI is a big part of it. We can talk about that in details if people want. We've got about 1.4 million barrels per day of year-on-year growth. Similar. I don't think there's a lot of difference. And the EIA came out this morning, raised their demand numbers to 1.3 million barrels per day. OPEC is the outlier in this, but I think people are kind of converging around that 1.4, 1.5 million barrels per day demand growth number. But what I do want to highlight in this is the difference in composition, because, and I'll end with a slightly more medium-term focus is, we've always been, all our medium and long-term forecasts have really been very bullish petrochemical demand, very bullish jet demand. And it's always talked about peak gasoline demand in, say, 2028 and diesel in 2030s. And that number varies. I know the IEA is earlier. I think we are probably closer to the EIA's numbers on a lot of these things, on the long-term stuff. And overall, our global oil demand number is higher than the EIA's or the IEA's. We think, and this is very important to highlight, that so we have it peaking at about 110 million barrels per day, close enough. But even by 2050, we have oil demand overall barely falling below 100 million barrels per day. And we think we need about $550 billion of investment just to keep 100 million barrels per day of production going. So there's a question mark around whether we are investing enough in the upstream to service demand. But the reason I raise the composition is because that 100 million barrels per day, call it like, we go to 110, we come down to 100, whatever that number is, in terms of the peak and then coming down, everybody's got a much bigger focus on petrochemicals. But what we are seeing, and if I go back one slide in China, we know the property sector in China, by design, is not going to go back to 2019 levels. The government doesn't want it to. The property sector in China is the biggest consumer of petrochemicals globally. China's got overcapacity in pretty much every sector. We were talking about electric cars earlier. The big policy is, yes, we're going to make electric cars cheap. I've traveled in BYDs when I'm in China. I would have that any day over a Tesla. It is a much better car. Having said that, it is genuinely a much better car. Having said that, I don't think Europe and Germany is just going to sit there and allow China to flood its markets with BYDs. I don't think most countries are going to allow that, because it's not just about national security, but it's about, then again, the whole thing that's happened with solar gets repeated. And Europe is banking on renewables and investment in electric cars and just generally the renewable sector to get itself out of a recession, to get itself back into kind of economic growth track. That's kind of the challenge on the petrochemical side, that there's too much capacity. Do we start getting a pullback? And then the flip side of that is we are seeing stronger gasoline demand growth. Talking to Sinopec, talking to PetroChina, they've been surprised as how strong gasoline demand growth has been even this year. People are spending more because they're also not buying houses as much. They're not being allowed to either. So I think that's very, very important to monitor for the simple reason, and this is going to be where I end. If we keep talking about investment in the upstream, look out for the downstream, because downstream, and this is hard to do, right? Because we've identified every single refinery that is going to come online all the way to 2030 and beyond. This is just till 2030 I'm showing you. The grayed out bars are mostly refineries that have been announced in Africa, parts of the Middle East, which we know that just not going to come to life. Net, because we are going to continue to see refinery closures. Today, BP announced another one in Europe. Net capacity additions between 27 and 30 is only 500,000 barrels per day. If demand growth at least is 1 million barrels per day each year, we're already short refining capacity. That's one. Two, a lot of this capacity growth is coming in China. So if you go back to I can point to the brown color here, it's mostly China, a bit in India. But China has changed its policy to basically not export as much products. It's capping it at 40 million tons every single year for the last 3 years. It's not going to change. If anything, the guidance we're getting from them is that it is going to continue to go down because they want to export petrochemicals and not clean products. So it doesn't matter if China builds all these refinery capacities, if that product isn't available to the market. I call China the Saudi Arabia of refining. It has all the spare capacity in the world, but it's not willing to use it. It's got 4 million barrels per day of refining capacity that's spare. So then if you go back, and then the final point is a bunch of these refinery expansions are petrochemical integrated. The new refineries in China, 400,000 barrels per day refineries only produce 60,000 barrels per day of gasoline and diesel. The rest is all petrochemicals. And that's why I bring up the composition. So I think the risk in this market, in this world of energy transition, when shutting down a refinery is the easiest thing you can do to hit ESG targets, and that's where the shareholder pressures still are. I don't think governments around the world are focused enough on downstream. Downstream is never sexy to talk about. People talk about oil prices, but none of us pay for oil. We pay for gasoline and diesel. And that's where I think the conversation needs to head to. It is downstream. It's looking really at the demand side and the composition of demand, because the risk is in the medium term, and i.e. in this decade, that it's that transportation fuels, it's gasoline and diesel cracks that remain very high, that pump prices remain very high. Regardless, I mean, OPEC has 4 million barrels per day of spare capacity. Crude upside is not the issue right now. The issue is really on the product side. So yeah, with that, I will end it, and I'll hand it over to Joe. And yeah.
Very hard act to follow. All right, let me just see if I can. Can I get my slides up? There we go. Okay. All right, so in my presentation, I have a few slides here. I want to provide EIA's near-term view on the global oil market. The insights that I'm presenting today are drawn from our short-term energy outlook. The March edition was just released this past Tuesday. Let's see. Okay, here we go. All right, so this is a really important plot. I think it provides a useful overview of the market, and it shows the relationship between Brent crude prices, which we have in the top panel, and then global inventory changes in the bottom panel. And you can see that as stocks build, which is indicated by those brown bars, prices tend to drop. And as stocks draw down, which are indicated by those red bars, prices tend to rise. So our February forecasts assume that there would be some voluntary OPEC Plus cuts that would be maintained, but in early March, those voluntary cuts were extended, and Russia added new voluntary cuts. And as a result, we expect markets to be much tighter in the second quarter of 2024 than we previously expected. So now we're forecasting that global oil inventories will fall by 0.9 million barrels per day in the second quarter, and you can see that drop right here. And for comparison, last month when we did the forecast, we assumed that the inventory draw would be relatively flat. So basically no change in inventory. So that's a big change in this month's forecast. If you look more broadly across all of 2024, we expect a net draw of about 100 million barrels. And then looking ahead to 2025, we expect global inventories to build to a net of about 130 million barrels. And you can see that this change in inventories is then reflected in prices. So you can see the difference in the Brent price between our February and March forecast. We're now forecasting that Brent prices will average $87 a barrel in 2024 and then $85 a barrel next year. Okay, this stacked bar plot shows the growth in global liquid fuels production. That gray bar that you see includes crude oil production in other countries as well as biofuels and hydrocarbon gas liquids, which are mostly produced in the United States. Last year and this year, you can see that production in the U.S., Guyana, Canada, and Brazil have grown significantly, while the OPEC Plus production has been scaled back. This year, we expect net growth of about 0.4 million barrels per day, and then in 2025, we expect growth of 2 million barrels per day. And then in the next slide, we'll take a look at OPEC Plus production in a bit more detail. Okay, so here the OPEC's maximum production targets are shown as the gray bars. And you can see the actual forecasted production as the blue line. So the blue line is taking into account OPEC Plus voluntary cuts as well as broader market conditions. And you can see that beginning in the third quarter of this year, we expect OPEC Plus production to pick up once the current voluntary cuts expire. And we forecast that OPEC Plus production will exceed 36 million barrels per day mid-year and then grow another million barrel per day by mid-2025. And you can kind of see that right here. So this is the beginning of the third quarter. You see that jump up in production. We cross 36, and then it continues to grow again by about a million barrels per day through the forecast horizon. Okay. So that's on the production side. We also want to take a look at consumption. So this bar chart is showing the annual change in global petroleum and liquid fuels consumption. You can see, the obvious effect of the pandemic and then the recovery. So there was obviously a massive drop in demand during the pandemic in 2020, and then you see this very strong recovery in 2021 as we began to emerge from the pandemic. And then looking ahead to our forecast horizon in 2024 and 2025, we expect an increase of about 1.4 million barrels today, which is pretty close to the pre-pandemic average of 1.5 million barrels per day, which you can see as that pink color on the chart. And one thing I want to emphasize is that this consumption growth is concentrated in non-OECD countries, particularly China and India. Those are my highlights. I just wanted to point to some additional products that we offer at EIA. So again, the results I just showed you are drawn from our short-term energy outlook. We produce that every month. We also have our annual energy outlook. This is our long-term set of projections that run through 2050. And then it might be the drilling productivity report might also be of interest. That report provides insights into the productivity of drilling operations in major U.S. shale regions, and it covers both oil and natural gas. And with that, I'll conclude my remarks, and we can move on to the discussion.
Come on up. I get the one on the end. Joe, you can choose your seat. Okay. Amrita. Thank you both, and welcome everybody to the conversation. Beautiful Washington spring day, I have to say, so I'm just grateful that we've managed to get a few people to sacrifice a little bit of morning outdoor time to be with us. Really grateful that both of you here today at CSIS. For those in the room, as well as those joining online, we have the capacity to have questions, either through the question box if you're viewing online, or we have a microphone here in the room. So please keep that in mind as we get going in the conversation here. The picture that you both paint is one for the next year of a lot of market tightness. And Amrita, I'd love to dig into something you said a little bit, which is that the physical market and the price seem to be moving like qualitatively in different ways. Can you help us understand what might be the intermediaries there? I mean, I would imagine that 10 years ago, people looking at this tightness, the price volatility would be a lot higher. What is something structurally changed that we should be paying attention to?
Yeah, I think it's a great question, and I think this is something we are constantly looking at as well, because ultimately, say if you are making any decision, whether it's a investment decision or even OPEC decision, you're looking at the price of oil. Nobody's going into the physical differentials and saying, okay, what's Dated Brent doing or what are the OSPs doing? But I think that's becoming a challenge. Couple of things. The market, I think, has become smarter in the sense that in the past, any geopolitical risk premium used to be on flat price. Like,
Right.
Can you imagine, I don't know, even 5 years ago, forget 10 years ago, the amount of Houthi attacks that we've seen on the Red Sea, and that prices wouldn't be like $120, like we'd be like $5, $3 range, right? That's really unheard of. I think one of the things, I think at least, that Russia has taught the market is that changes in trade flows gets reflected in products prices rather than crude prices. And you've seen product prices or just refining margins and cracks remain elevated for the last 3 years versus historical levels. Yes, we've closed down refineries, but I think that's been the market. I don't know if it's gotten smarter or whatever, but you've seen a difference. We're seeing more people express their views in products than crude. That's definitely one aspect of it. The other aspect of it is we've seen just more regulation, less and less kind of participation from what I would call human beings in this market, but much bigger growth in algorithmic trading, the CTAs as people call it, in the trading community. And I think that's, in some ways, is very dangerous because the CTAs are just programs, right? They kind of come in, and some of the moves you see, they are big moves up and down. And that's actually resulted in big losses for a lot of traditional hedge funds who've been in this space. And then if you don't, and this is where regulation kind of can go the other way, right? Those guys, the CTAs aren't regulated at all. And all the regulations kind of, banks don't really trade anymore, and because of Dodd-Frank and MiFID and so on and so forth. So I think it's been a shift in how this market, used to be back in the day. Hedging profiles have changed. Airlines used to come in and hedge crude oil prices. Today they try and do they mostly, when I'm sure you guys all realize when we are trying to buy tickets these days, they are much more expensive than they used to be in the past, in part because all that fuel surcharge gets passed on to consumers.
Right.
So all of that behavior has changed, but I still think the last couple of years, really since COVID, that disconnect is getting wider. See, ultimately, it closes, right? The problem is you get periods like this where either the physical is much weaker, and we saw that in 22 when the SPR, remember, we had very strong prices all the way through the summer, but we were building. Then when the collapse came in prices, it was because the physical was much, much weaker. And hence I wanted to highlight it is that ultimately they do catch up to one another. This time, if what both Joe and I have shown is a much tighter market, then the catch-up is going to be to the upside in the summer. Flat price will catch up. It's just there's a much bigger lag these days, I find.
Yeah, so I hear kind of two things going on. One, I mean, we experience this regionally in the United States all the time, right? The sort of the difference between products prices and the signal there and general crude prices. EIA is at the forefront of trying to track those relationships. But then also the rise of computer-driven trading is kind of creating
the
damping effect on upward. Does that create, are the machines giving us a false sense of security when we look at these medium-term forecasts, or are we just in a different market structure now?
I think it's both, right? It is, we are in a different market structure. False sense of security, you could also argue that sometimes they would buy on crazy headlines as well, right? Like some of the stuff we've seen, and I think just more and more social media there is, and more, unchecked news, as I would call it. There are headlines from 5 years ago that get recycled sometimes, and the market reacts to that. And you're just shocked at how, again, if it was a human, they would kind of figure it out and not trade on it, right? I think that's kind of partly the challenge we have. But in general, I would say just a very brief point on this is that data, right, and data quality is also a big challenge in this. And two things I'd highlight: satellite data, ship tracking data. A lot of people think that more data is good. I don't necessarily think that's the case, because a lot of times it's garbage in is garbage out, because you're not necessarily taking the satellite images of the same tanks every day, and then you're doing day-on-day comparisons, but if it's different tanks. Ship tracking, how many times have you seen Bloomberg come out with 1 week OPEC numbers or 2 week OPEC numbers? Loading programs, particularly out of the Middle East, are very first half weighted every month. Second half of the month, I don't know exactly what, I mean, I have reasons to believe it's to do with sailing times and so on, but basically they tend to front load their exports and then they reduce it in the second half. You should always look at monthly averages, but everybody's now like, oh, we've got tanker tracking data, oh, OPEC is cheating. 1 week, and then, oh, OPEC has cut back. I mean, that's the kind of stuff you deal with on a daily basis these days.
Just like high frequency signals being misinterpreted. Joe, I want to go to you and talk a little bit about the American story over the last couple of years, because it seems like in 23, U.S. production surprised everyone. Amrita, mentioned the sort of pre-acquisition activities, right? Maybe companies trying to pump the numbers up a little bit. How is EIA looking at the last couple of years of U.S. production, and how's that affecting your forecasting for the near term?
Sure. So let me give you some production numbers just to give some context. So production in 2023 in the U.S. was just under 13 million barrels per day. We're forecasting that it'll be about 13.2 million barrels per day this year, so just a slight increase. When you look at the monthly time scale, you get more, sort of more granular insight. We reached a high of 13.3 million barrels per day in December, and that was an all-time high. Production contracted a bit in January, but we do expect output to pick up over the next several months, and we'll be close to that 13.3 million barrels per day again in August. And then if you look at the longer term part of the STIO out in 2025, we think that we'll hit about 13.6 million barrels per day, which again would be a new record. In terms of some of the things that we're looking at, I mean, it's clear that wells have become more efficient and productive. There are, seem to be continuing advances in horizontal drilling and hydraulic fracturing. And so as a result, producers are able to extract more crude oil from new wells, and we're getting higher sustained productivity from legacy wells in recent years. And again, for more detailed data on that, you can take a look at our drilling productivity report, which is released every month. And then there's, it's maybe worth mentioning the drilled but uncompleted wells as part of this. So what we've seen is over the past 2 years that producers have really increased their well completions, and that's reduced the large number of drilled but uncompleted wells that built up during the pandemic. So producers, they can still draw down those DUCs to keep production somewhat stable and growing slowly, and that's partly reflected in our forecast over the next few months. And then, of course, higher prices can play a role here. So if we have higher sustained prices, that can lead to more drilling activity, and that could happen in a way where producers can both drill new wells and then complete wells without reducing the number of DUCs. So those are just some of the things we're looking at.
Excellent. Let's talk about product prices a little bit, right? So the sort of like the man on the street impression is U.S. is producing a ton of oil. We should see our prices go down at the pump, right?
Yeah.
Just flat out. We saw last year pretty substantial decreases in pump prices. EIA now sees upward pressure on the product side. Can you give us a sense of what's going on there? Do you see echoes of what Amrita is talking about with changes in the refining sector and refining capacity being a bigger issue for consumers?
Yeah. So a few things there. Right now we're seeing lower refinery throughput in the United States. refining activity has dropped sharply in January and February of this year, and that's for a few reasons. We've had weather-related outages. There's planned refinery maintenance, and then there was also a major unplanned outage at BP's Whiting, Indiana refinery. And so that's limited our ability to refine. So if you start looking at inventory levels, East Coast and Gulf Coast inventories ended February about 5% below the 5-year average. Okay, so inventories are kind of low. And those two regions are particularly important because they, both on availability and prices, because there's a lot of production and demand in those regions. And then the final thing is there's ongoing geopolitical risk, and Amrita covered this in her presentation. So we're also looking at the news, the drone strikes on Russian refineries, what impact that might have on prices. Right. So that can also have a big impact on the refined product prices.
Amrita, you like the kind of shift to concern more on the downstream side is something we've talked about before. How much, and it looks like a global problem, right? So you showed us, sort of 1.5 million barrels of increased demand going forward. That seems pretty consistent with the EIA. Refining capacity is not going to be built to meet that. What happens?
I think what happens is, refiners profit a lot, and hopefully they stop shutting down. But I think that's where the challenge is it's almost where markets are not working, right? For the last 3 years, like I've been saying, that refining margins have been much stronger than any of us had expected. Like 2015 to 19, we had negative margins, refineries needed to close down. Yet, even at record margins, refineries like Lyondell in Texas, they've come out and said, we're going to shut down our refinery. This is when margins were $60 per barrel. So these are not economic decisions, right? These are decisions being made driven by ESG concerns. And one of the things I always hear from our refining clients is oil demand, and that's one of the reasons why I said we kind of need to focus a bit more on that, is that if everybody keeps talking about peak oil demand, right? Refining in some ways is the worst affected in this energy transition world because it's got the longest lead time. Yep. If you're at board meetings, I'll get asked these questions about, okay, when is oil demand peaking? And then they're like, oh, but the EIA is saying X and so-and-so is saying Y. And I think that becomes a real challenge for them, is that you don't know when oil demand is going to peak, because everybody, and it's very, very wide-ranging views, by the way. I was going to put in a chart here. We've mapped out pretty much from the BP shells of the world, EIA and OPEC, everybody. The range is like massive. You're talking about 50 to 70 million barrels per day, depending on which case of the IEA you take.
In sort of like future demand over the next 2 decades.
2 decades, right?
Okay. Yeah.
So how do you plan for that, right? And the pressures are the general
plan
narrative.
To lose money on that refinery.
So the general narrative is, don't invest, oil demand is going to peak because you're not going to make the returns on this.
Yeah.
And that's where the challenge is. And how are we going to resolve that? I genuinely don't know.
So do you mean, is this going to be a question for public policymakers going forward?
It has to be.
I'm in Washington, so that's like, hammer meets nail. But it really does feel like, because, I totally get, like, it's not quite an energy transition story. It's like an impending energy transition story. Yes. And we've had CEOs here at CSIS say, like, we're not going to build another refinery in the United States. It'd be crazy to do that. We wouldn't be able to finance it. We don't know if we would make money. Like, because of all that future uncertainty, this is exactly where the role of government seems to be necessary, because there's just a misalignment between the financial incentives, right, and or the business incentive, and this like huge uncertainty. Joe, how do the data providing agencies, you've spent so much of your career looking at uncertainty in forecasting. Are we in a position where we're going to be able to try and inform public policy in this way, regardless of what public policies we might try to impose?
Well, first thing to say is EIA is policy neutral, so no
policy position. I know. Position to inform whatever the policy situation may be, Joe.
Right.
Yes.
I mean, I don't have I think our role is to provide the data, for others to evaluate.
Right.
And there is a lot of uncertainty in the market. I mean, I was going to mention just in our own international energy outlook, we look at a range of scenarios, and by 2050, we see, crude oil production growth anywhere between like 6 and 40% of current. So, I mean, it's inherently uncertain.
Right. Well, I guess that is actually the fundamental question that I have, right? Is like, do we have the right tools in place to even understand this kind of uncertainty when we start talking about this, the refining capacity, the intermediary on product production, how the downstream is going to be allocated between petrochemicals, gas, fuel, in the same way that we might have a good sense of, well, okay, here's this range of production on the crude oil side.
Yeah. I don't know. I mean, I think
it might not be an answerable question.
Yeah, I guess I don't have a great answer to that.
Fine.
I think, at EIA, we're really focused on the U.S. market. I mean, our authority derives from Congress, and it's focused on being able to collect data on U.S. industry. Obviously, with oil, it's a global market, so there's a much bigger picture there. And I think, there's a challenge in pulling together all the appropriate data sources to put together a coherent picture.
So if viewers, Amrita, want to get smarter on this question of refining capacity and the potential tightness that we'll be looking in there, in the same way that 15 years ago they might have needed to get smart about which new fields are going to be developed, what are the key indicators that folks should be watching for?
I think it's a great question, and even going back to your previous question, I think the challenge is that downstream inherently is far more complicated than upstream, right? Like, if you look at upstream, governments do give you data. This is production. You can go through company earnings calls and kind of figure out a lot more of that. Downstream is just not something. Downstream's always been done analysis-wise as well in-house, right? We've actually built out, and that's kind of been our big focus, building out our refining capability. We're now mapping every refinery in the world with its output, precisely because everybody's like, oh, this refinery got hit, what's the loss? All of that kind of stuff. It's not something everybody keeps saying to us, we have to otherwise Google for like 2 hours to find kind of these details.
Right.
So from my point of view, that's kind of the data, or that's where the data transparency needs to improve. I think overall, historically, it's always been supply, demand. Who and how many of us have really focused on the this is like downstream and midstream, right? It's pipelines, it's refined, it's like infrastructure, effectively, for a lack of a better word. So I mean, that's one of the things we tend to focus on a lot, is like is it power plant infrastructure, is it pipeline infrastructure? And refining has been one of the biggest things we've done, precisely because of that, because without that, I think doing the analysis, even going out to 2030 was a big project, because half these projects, they get announced, and then you find out afterwards that it's been retired and it's not going to come online. But I think the answer almost to your question is that if policymakers start asking the question, analysis and research will be done. We only get asked this, and the reason we've even built this out is because we are getting asked this by very specific NOCs, I would say, not even IECs, national oil companies who, remember, they have a mandate to kind of think about this and say, oh, will there be demand for our crude oil?
Right.
But because policymakers, particularly in the West, are so focused on the crude oil price, this has not been the focus. I think some governments we've had interactions with are waking up to this, saying, oh, if we shut down this last refinery, what does this mean for our kind of import costs and so on? Right. But this is why I think, and especially kind of being in DC, policymakers have to start thinking about, or at least asking questions about it, because that, by definition, will then lead to funding flowing into this area, et cetera.
Yeah. I'm going to take a question from online, and then if anybody in the room wants to ask a question of our speakers, there's a microphone in the back, and I'm happy to have a short cue form. The U.S. was not the only surprise in the oil market in the last few years. We've had the rise of Guyana, and Brazil is increasing production. Comment from either of you on the cost of production between the Gulf, Guyana, Brazil, U.S. shale. Sort of how do you see the balance of those things over time, either in EIA modeling or in what you've studied?
I don't think I have a lot to say beyond what I presented. I mean, in the STIA, we have a horizon that runs through 2050, and then the other place that would come in would be in our International Energy Outlook. And I'm not sure what assumptions we make there about the balance.
We've got strong growth in Guyana. Canada as well, I would add to that mix, actually. Yeah. Canadian production will grow with TMX coming online this year and next year. So for us, the non-OPEC supply... Not a fire alarm, right?
No, not a fire alarm.
Just checking.
Yeah.
Never know with these days. We've got strong growth in the U. Oh, wow, strong, not last year's growth, but growth in the U.S. continuing over the next couple of years. Brazil, Guyana, Canada would be the main sources of production growth, mainly because, I mean, I think beyond that, North Sea, yeah, it's pretty much done. Kazakhstan a little bit, but not much, right? The only thing I would say, and which is very, very interesting, we found Brazil's been 10 years of underperformance, and then suddenly last year, it kind of came out of nowhere, and I think that's why it surprised people. Guyana, I think people expected. The thing I would highlight is one of the things we are seeing in upstream is just the use of AI. And I know AI just gets thrown out, that phrase gets thrown out a lot, but companies are getting better at or just the amount of data that they're mining, not just in terms of maintenance, but one of the things we've been talking to a lot of the upstream companies about is, okay, the water quality, therefore corrosion. They are able to do preventative maintenance better. Think about Brazil. One of the things that would always happen is so-and-so FPSO would go offline for unplanned maintenance, and that would take longer. They're able to take some of these things off beforehand, prevent that. And I think that kind of stuff will allow non-OPEC supply to go that bit further with the amount of capex that we are getting right now.
And I want to pin your thoughts on the EIA modeling shows OPEC cuts expiring and then returning to production. Given all that you're talking to folks in the Middle East and in OPEC countries all the time, what's your view on the kind of medium term strategy there?
I would say this year, again, there's not going to be a rush to bring barrels back.
Right.
So like maybe even through the end of the year, or at least even if they bring it back, it will be very gradual, Next year, they have a big meeting to go through everybody's baselines. That's going to be a very, very difficult one.
Right.
I don't think it's over Thanksgiving. Usually, they always put it over Thanksgiving. So I think you guys will have to enjoy this one. 2 to 3 days long, potentially, who knows, the December one. So I think that's going to be a challenging one because, look, this is why I raised the U.S. production question. If you get another year of 1 million barrels per day, those barrels are going to come back to the market, right? But ultimately, it's not going to be, I mean, this is not 2020, right? Nobody's talking about a market share war.
Right.
It's much more about, the way I frame them is that they are constantly revenue optimizing.
Yes.
They're constantly looking at, okay, if we brought barrels back now, overall, do we get more revenue versus if we didn't, and then what would be the downside to the upside? So that's the way I would look at them, and then that's also why I don't think they're in a rush to bring barrels back this year. Next year, if economic growth is a little bit better, then they will start to add barrels back.
Very interesting, lots there. Let's take a question just for folks who are going to ask via the microphone. If you wouldn't mind introducing yourself and any representation that you carry. A question has a brief prepositional statement and then is followed by a sentence which goes up at the end. Thank you.
Sure. Hi, my name is Ben. I'm with BP America. I had a question about recent M&A activity in the U.S. with Chevron and Hess and ExxonMobil and Pioneer and et cetera. And I was reading a number of analyses about how these mergers and acquisitions would result in greater contraction in oil output in the U.S. I was just wondering if either of you had a comment on that, whether you agree with that and how you're baking that into your forecast over the next several years. Thank you.
I guess, obviously we watch the market carefully. I mean, 2023 was a big year for mergers. Ultimately, in the modeling work that we do, if there's a barrel of oil that's profitable to produce, it finds a way to reach the market. So we're watching the market very carefully, but there's not sort of the structure embedded in the model to take that into account. But that's why that's why the STIO is produced every month, so that we can track these things, and if we see, price excursions, we can kind of build that into the forecast.
I think what you've read is accurate, and that's kind of what we see, and exactly to Joe's point, that I think you can see that on a month-on-month basis as well. Last year was interesting that these companies all surged production before they were getting bought. Usually what we see, and historically you can go back and see pretty much all the companies, 1 + 1 never quite adds up to 2. It's about 1.5, because a lot of these rigs are not deployed. Like, they'll take over assets. especially if they are adjacent, they produce from there, but the other assets, we've seen that with companies without naming names, they've kept the Permian assets, gotten rid of the DJ Basin assets, things like that. We've just put out something, I think it was yesterday, if you go through it company by company, production growth is actually 7%, but the underlying growth is actually only 2% because with the mergers, they're kind of taking over assets of other companies, but not growing it to the fullest potential. Because if you think about it, part of the issue with shale last decade was we were growing from like anywhere and everywhere, and I think consolidation just stops that. You will grow the best acreage, and to Joe's point, that the most profitable ones.
Right.
Last decade, we weren't growing the most profitable ones. We were just growing. So yeah.
Making big bets. Go ahead, sir.
Hello, good morning. Oladipo Kusaga from the British Embassy. I think we've had a good conversation on crude oil and just the oil market. It would be great to get your views on the gas market and where you see that going for the next few years. Qatar production, in the US, and generally where we see, Europe in the mix.
Do you
Wanna
want me
go
to-
first? Yeah, go for it.
Sure, okay. So, all right, with regard to natural gas, I'll focus my comments mainly on the U.S. because that's the data that we track. But when you look at natural gas inventories, they're relatively high with respect to the 5-year average. I don't remember exactly where it is right now, but it's quite high. For a while, it was above the 5-year range. Prices in the United States are also at decade low levels. I mean, right now it's still below $2 per MMBTU. I think in Europe and Asia, it's around $8 million per MMBTU. So prices are really low. What we're seeing is that companies are reacting to what they're seeing in the market, and so they have announced production curtailments, and there are now lower rates of investment in production. And so that's what's driving our forecast that production will contract a bit. But we do, in terms of, U.S. natural gas reaching the market, I mean, we do expect to see growth in LNG exports.
Amrita?
I think the only topic, well, not the only topic, but the main topic of conversation in DC has been gas, I think, for a while now, thanks to some of the pause in LNG from the US and so on. Our take on this is, look, our views are similar to Joe's in terms of the US market. We have gotten US companies finally announce that they're going to shut in some production. At these price levels, it doesn't make sense to produce, so that's one thing. But slightly more kind of, so we bearish US gas prices this year, we bearish European gas prices this year and next year, actually. And then the question becomes, when is this big wave of new projects coming online, which is around that 2026 to 2028, right?
You mean a new LNG
New
projects?
LNG projects
Yeah,
coming
thanks.
online,
Yep.
US, Qatar, there's a bunch coming online. Then what is now interesting is Qatar's, of course, come out with the recent announcement, and the timing of it couldn't be more suspect. As soon as the US announced the pause, Qatar comes out. And I think the thing for me is that US will still be the biggest LNG exporter, right, by volume. That's not the, well, okay, let me rephrase. It will have the capacity to be the biggest exporter by volume. That doesn't necessarily make it the biggest exporter by volume. I think one of the things we are sensing from our Asian clients is that Asia is always very nervous about energy, right? It's net short energy. This pause has created more of this anxiety in Asia, saying, can we rely on the US as a reliable supplier? They've gone to the Middle East, signed some more contracts. And now the tightness, we had a market tightening up between 2028 and 2030, 2032. Yep. Qatar has just killed that with this expansion plan. So in some ways, you could have US gas prices staying lower for longer because now that's not going to necessarily, like, you don't need those additional barrels. So the analysis we're doing, it's almost flipped around and now almost talking about, oh, do we keep getting these price levels where US has to shut in production to balance the market, right? And I think this is, again, a policy thing, and it's a, everybody I spoke to here has been like, oh, but we're going to be the biggest capacity-wise. But capacity is not the same as actual exports.
Yep. Very interesting. I'd actually like to follow up on that. But let's take this question real here, and then we'll...
I'm Bob Hershey. I'm an energy consultant. What effects do you see in industrial energy use?
When you say industrial energy use, just as a point of clarification, do you mean sort of like the manufacturing, petrochemicals? Can you give us a
All
little
of
bit
the
more?
above.
All of the above. We're back right? We're making stuff again in the United States. The global economy is recovering from COVID, with the U.S. in the lead. How do you think about the sort of this new era of supply chain diversification affecting energy strategies around the world? Amrita, go ahead.
I'd say we are already seeing, we've already seen gas demand in the US hitting record highs last year and this year as well. Europe is different because Europe has lost about 15% of gas demand, in part because the US has taken some of it, thanks to IRA.
Right.
And I mean, I know it's a terrible acronym, particularly for those of us in Europe, but still. But it is one of those things. But I think fundamentally, I think it's a very good question for one reason, is that a potential source, I think it's still, the jury's out there, is all these data centers, right, that are going to come up, and the US is the hub of it. We are hearing estimates. I mean, some of these are crazy estimates, right? 130 gigawatts of additional power demand in the US by 2030. I mean, I think that's going to be like a 35% increase in power demand. I mean, you won't need the LNG exports because everything is going to get consumed here, and you'll have high gas prices.
Right.
Again, data is very limited right now in trying to get the analysis done, but it is genuinely a source. We are starting to see demand come through, and it's quite lumpy as well, right, when it does come through some of the regions. So we will see more. Again, it goes back to my comment about, I think as an industry, we need to do better at predicting oil demand than anything. Oh, sorry, not oil, energy demand than anything else.
Right.
Because we keep talking about these peaks.
Yep.
Some of the, like IEA's long-term outlook also talks about gas demand peaking imminently. We don't have that at all. We think gas is going to actually remain, gas for us in the long term is the fastest growing fuel in absolute terms. Renewable is on a percentage basis. And I think gas is going to be one of the biggest beneficiaries in terms of industrial demand.
Yeah, my impression, we were talking earlier about uncertainty in future oil markets. If you look at the IEF kind of summary of forecasting, the uncertainty in the global gas market in 20 years, I mean, it's larger than the global gas market was 10 years ago.
Yeah.
Right?
That's
It's
a very
just
good way to put it. Exactly.
Absolutely enormous. And so lots to work on as we all navigate this period together. Joe, do you have any final word on the industrial question?
Well, I was going to say, I mean, I think that uncertainty, I mean, there's a lot going on, right? I mean, things are moving so quickly. I mean, you've got rates of technology innovation, you've got the demand, question, and how much that's going to change. And then there's the policy question, what policy is enacted, and how does that move energy markets. I guess specifically with industrial energy demand, that's not something that we break out in the steel, but in our international energy outlook, we do see growth in natural gas and petroleum consumption to meet generally to meet industrial demand. Again, there's a range, but it's generally increasing.
Right, and then this sort of new era of industrial policy, I think, just sort of like we have to start thinking about scrambling what the geographic distribution of that
yes,
demand is.
and there are that's an important point. I mean, when I say that, I'm talking global aggregate. When you start looking at a regional or country level, it can vary quite a lot. And again, we have a very strict interpretation of policy. Like the policy has to be on the books. There has to be an enforcement mechanism for the policy. Right. And so that is an assumption that kind of underlies all of our long-term projections.
To me, if I may, we're going to be facing on this kind of load growth question as we talk about it here at CSIS. We're going to face some of the same pressures and questions, Amrita, that you were talking about on the product side, where if we're in a position where new load is coming fast and coming hard, we're policymakers and utility commissioners and this whole architecture is going to have to think really judiciously about, do we want yet a marginal data center, or do we want this set of factories? And the relative economic and strategic value of those two things may be quite different. It's going to be a really interesting period.
And I think it goes back to, for everything, whether it's energy transition or just generally keeping the lights on, right?
Yeah.
I kind of really think the policy question and the focus has to be on infrastructure, and that's why I call it infrastructure as a whole, be it kind of the data centers or pipelines, or we haven't even mentioned power grids. We have to invest in grid stability if any of this is going to work, right? And we just, there's nothing being talked about or done.
Yeah, there's nothing like opportunity to cause great stress and anxiety. Let me thank you both. Just a couple notes. So we're summer driving season. We look forward to tightening markets and some rising prices. U.S.
I like how you say you look forward to
Loves
tightening
that.
markets.
We've got the big OPEC meeting in November, and I just want to express my gratitude to you two being here today, sharing your thoughts and your wisdom. Colleagues, if you wouldn't mind giving them a warm round of appreciation. Thanks also to my colleague Ben for starting us off. This is Joseph Majkut for CSIS. Thank you all online for joining us. We're now signing off, and we'll see you next time.